Foreign exchange risk hedging strategies, external forwards, presented by Niriksha, MCOM final, MPM Government First Grade College Karkala, Mangalore University. Meaning, a currency forward is a binding contract in the foreign exchange market that locks in the exchange rate for the purchase or sales of currency on a future date. A currency forward is essentially a customizable hedging tool that does not involve an upfront margin payment. Here, a currency forward is a customized written contract between the parties that sets a fixed foreign currency exchange rate for a transaction that will occur on a specified future date. The future date for which the currency exchange rate is fixed is usually the date on which the parties plan to conclude buy or sell the transaction of the goods. The other major benefit of a currency forward is that its terms are not standardized and can be tailored to a particular amount and for any maturity or delivery period, unlike the exchange traded currency futures. The forward rate is the exchange rate you agree on today to transfer your currency later. It can be calculated based on the spot rate and adjusted to take into account other factors like the time until transfer and which currencies you are exchanging. The forward rate you agree on today does not have to be the same as the rate on the day the exchange actual happens. Forward contracts are frequently used by corporations that deal with foreign exchange. They are not traded on the organized exchanges but traded directly between the two parties involved practically for whatever the amount. Understanding currency forward contracts. Currency forward contracts are primarily utilized to hedge against currency exchange rate risk. It protects the buyer or seller against unfavorable currency exchange rate occurrence that may arise between when a sale is contracted and when the sale is actually made. However, parties that entered into a currency forward contract forgo the potential benefit of exchange rate exchange that may occur in the favor between contracting and closing a transaction. While currency forward contracts are a type of future contract, they differ from standard future contract in that they are privately made between the two parties involved, customized to the parties' demand for a specific transaction, and are not traded any exchange. Since currency forward are not exchange traded instruments, they do not require any kind of margin deposit. Because currency forward contracts are private agreements between the two parties involved, they can be tailored to preciously fit the parties' respective needs regarding a monetary amount. The agreed upon exchange rate and the time frame that the contract covers, the currency exchange rate specified in a currency forward contract is usually determined in the relation to prevailing interest rates in the home currency of two currencies involved in a transaction. When currency forward contracts are used, currency forward contracts are typically used in situations where currency exchange rate can affect the price of goods sold. A common example is when an importer is buying goods from foreign exporter and the two countries involved have different currencies. They may also be used when an individual or company plans to purchase property in a foreign country or for making maintenance payment related to such property once it has been purchased. Currency forward contract may also be made between an individual and a financial institution for purposes such as paying for a future foreign vacation or funding education to be pursued in a foreign country. Currency forwards contracts are most frequently used in a relation to a sale of goods between buyer in one country and seller in another country. The contract fixes the amount of money that will be paid by the buyer and received by the seller. Thus, both parties can proceed with a firm knowledge of the cost or price of the transaction. When transaction that may be affected by fluctuation in currency exchange rate, it take place at a future date. Fixing the exchange rate enables both parties to budget and plan their other business action without worrying that the future transaction will leave them in a different financial condition than they had expected. Here one example given. Company X in the UK imports oil worth 1 million euros from company Y in the USA. As per their deal, Company X has to pay the amount within 90 days of delivery. Let us assume that the current exchange rate is 1 euro equal to 1.2 US dollar. So the exporter Y in the USA expected US dollar 1.2 million within 90 days of delivery. However, the currency exchange rate are volatile and may increase or decrease in the next 90 days. The exporter want to insulate himself from such a risk. Hence, enter into a currency forward deal with the bank. The bank offers an exchange rate of 1.19 on the 90th date, which is slightly less than current rate. Next, the company Y receive 1 million euro on the 90th day from company X and deposit it into the bank. The bank applies the locked exchange rate of 1.19 and gives them 1.19 million, irrespective of the current exchange rate. If the rate tips below the locked limit, the bank suffers a loss and the exporter successfully evades it. If the rate goes above the locked limit, then the bank have a profit. Hedging versus speculation in forward contract. The speculation involves trying to make a profit from a security price change, whereas hedging attempt to reduce the amount of risk or volatility associated with the security price changes. Speculation refers to the process of figuring out which way the marketer will move in the future and taking position on various assets and stocks depending on those projections. It is highly risky and it akin to gambling. Speculation is done by those who claim to read the markets very well. Hedging is done by companies to reduce their risk exposure due to the fluctuation in the commodity prices. During hedging, companies and investors take offsetting position opposite to their current holdings so that the net comes as close to zero as possible. A hedge is an investment position intended to offset potential losses or gains that may be incurred by a companion investment. Next, types of forward contracts. First one, closed outright forward. This is the simplest type of forward contract where both parties agree to exchange currencies at a future date by locking in an exchange price. These are also known as European contract or standard forward contracts. Second one, flexible forward. With flexible forwards, the parties can exchange the funds before the settlement date, often in parts, as long as the entire amount is settled by the due date. Parties can exchange the funds before the settlement date. Third one, long dated forward. These have the same functionality as any forward contract, except the settlement period often extends over more than a year. Generally, most forward contracts are short-term contracts, which is what differentiates the long-date forward contract from the rest of them. Fourth one, non-deliverable forward. Usually, parties enter into forward contract over a physical exchange of commodity, an asset, or currency. However, with non-deliverable forwards, the parties only exchange the difference between the contract rate and the spot rate at the time of maturity. Next, advantages of a forward contract. The following are the advantages of a forward contract. It is highly customized. Great way to hedge against the fluctuation of the market. Lowers the international trade related risk. No upfront cost for hedging. And the forward contract is easy to understand. It is a tailor-made contract and is flexible to adjust the needs of both the parties. It offers a complete hedge, that is delta neutral hedge, and helps in mitigating the risk. And it can be matched with the time period and cash flow of exposure. As it is over the counter contract, the price of contract are not known to others, hence provided a price protection. Normally here there is no immediate cash outflow before settlement of the contract, but might require an upfront fees, that is margin. And it is a tool for speculation. In the forward contract, there is no daily marking to market requirement as mandatory in future contract. Next, risk or limitation of a forward contract. Very little public information about the market cap due to lack of regularization, prone to counterparty risk such as non-payment due to defaults. In a highly volatile market, forward contract may hurt a company that miscalculated the movement of the price. So, the forward contract is a private contract. There is a no liquidity. Counterparty's risk of defaulting on the contract is too high, and the market of forward contract is extremely unorganized as it is traded over the counter. It may be difficult to find a counterparty to enter into a contract. Thank you for watching.